Hello, everyone, and welcome. We'll let people filter in for a second, and then we will get started.
I think we have a good one today, Lauren.
All right, Yusuf, I think we are ready to go.
Wonderful. And thank you all for being here. Before we dive into our presentation today, we felt it was necessary to acknowledge the events unfolding both domestically and abroad. We appreciate that YeskeBuie is a financial planning firm, and while our focus is not on politics, our purpose is to empower people to pursue their live big lives. Empowerment requires both education and the opportunity to take action. And so, we will focus our comments today on topics about which we can provide productive information to empower you as it relates to the decisions that you make along your financial planning journey. Now, had this webinar occurred before President Trump reversed course on Greenland last week, we would have included comments about that story with a focus on how the proposed tariffs could have affected domestic and international economies. And yet, after some truly bewildering developments, President Trump changed direction. And we note that markets didn't blink throughout the most recent chapter in this ongoing ordeal. And we interpret that as a demonstration of the collective wisdom of investors around the world. And we, as people and financial markets and economies around the world, will continue to press on. Further, because the actions of ICE and the Department of Homeland Security do not directly affect financial markets or the economy, we do not have any prepared comments on recent developments. However, that does not mean that we are not aware of the atrocities that have been committed, nor does it mean that we are ignoring those stories as they are reported. This affects us on a human level, and we acknowledge that you and people you love may also be affected. And as humans, it was clear to us that we needed to say something. And so we say this: we are in this with you, and we are here for you. And with that, Lauren, I think we can get started.
All right.
Disclosures, because of course we have to. I'm not sure how long we need to leave this up, Lauren, but a few housekeeping things that we need to cover.
Yes, if you are a regular here, if you have questions at any point, please feel free to enter them either in the chat or the Q&A. And I'll be monitoring those throughout. If they fit with the slide we're on or the topic we're on, and there's a good point to ask, I'll ask Yusuf in a moment. We'll have a conversation about it. If not, we'll circle back to them at the end when we have space for questions. And if for any reason we can't get to any specific ones, or you have very specific personal questions that relate to your plan, I will make sure we note them down and get back to you individually thereafter. So today, on the right-hand side here, what many of you may be experiencing this week, some snow, but what we'll be covering. First, just some quick updates on some Q1 financial planning action that we are taking in service of you regarding safe spending, if you're spending from your portfolio, and those two words that people don't want to hear already in January, but it's here, tax season. So we'll cover some details there. We'll talk about financial markets, some predictions versus reality, 2025, international US, and 2026. And then wrap up, again, if you're a regular, you might notice the cadence here, wrap up with some economic data, some numbers, some interest rate expectations with the Fed's discussion this week. And so with that, we'll start with Q1 action on the right side here, what us Californians may be enjoying instead of the snow, some sunshine and clouds and fog. Saw pictures of snow this weekend and it was 60 and sunny here. So, but Q1 is busy for your financial planning team. There's a lot of trading going on this time of year because in December there are portfolio distributions in the form of dividends and capital gains distributions. There's excess cash. And so for clients who are in that accumulation phase, we are investing that, putting that money to work for you. For those who are in the safe spending, so decumulation phase, retirement, portfolio paychecks, January is all about the safe spending system. And that comes in a few different formats that if you are spending, you have seen and will see. First, actually updating your safe spending policies, looking at what happened in 2020, what was the current balance of the account 12/31/25, what was the performance, what was inflation, and applying those three guardrail rules to your safe spending target to determine what your 2026 target is. If you haven't received that email yet, you will be in just the coming days. Those are almost complete at this point. And then also placing trades. So for our safe spending clients, that is rebalancing, raising cash for the coming 12 months need. So our cash needs policy is that all known cash needs are in cash for 12 months. And that's because in the short run, we don't know what is going to happen in the market. And if you have a known cash need, we want it there and ready for you in cash. And then specifically, some of the rebalancing for these spending clients is what we refer to as the stable reserve. The bonds in your portfolio, they are very intentionally there for stability. If and when, actually when a downturn comes, we know there will be one, we know there will be many, we don't know when they'll happen, but it's about having resilience to weather the storm. And so for our safe spending clients, part of this rebalancing that we're doing is also topping up the bonds in the portfolio. And as you'll see and have seen, 2025 was a great year. The stocks grew to a bigger chunk of the portfolio. And so part of this rebalancing is not only raising cash for that spending need, but topping that bond stable reserve back up to the full target. And so that's, there's a frenzy of trading and safe spending and lots of conversation the financial planning team is having about each of you in those various phases right now. And then tax season, those two words. If we have any of our wonderful accountants on call today, good luck. You can do it. You're heading into the craziness. And we're here to support in any way we can. And some of the stuff that we are doing in service of you all, our clients, is working on 1099s. And so 1099s are the tax reports that you get from Schwab related to transactions in 2025 that you then provide to your tax professional for filing your taxes. The 1099Rs are for retirement accounts. If you had a retirement account and you took distributions in 2025, your 1099R for those accounts is available to you on Schwab. You can access it online. If you have paper settings, it should be in the mail to you momentarily. The 1099s for taxable accounts. So if you had a trust, a brokerage account, a designated beneficiary account, anything like that, that was funded and invested last year, the 1099s will come out in February. The projected date is later in February. Schwab is hoping to avoid having to send out a lot of corrected 1099s, which happens when they send them really early and then the mutual fund companies send updated information. So those are coming next month. And those, we will be sending out an email actually next week. You'll see an email from us regarding 1099s, how you can access them online. If we have a relationship with your tax professional where we send them those 1099s on your behalf, we will let you know of that. So that's all coming over, some, like I said, some available now, some starting to be available over the coming month, and information that we're watching out for. And you'll hear from us next week on specific plans for your 1099s. And with that, we can move on to the good stuff.
Well, there's a lot of good stuff in what you just went through, Lauren, and as you well know, happy trading means I'm happy. But on to the webinar and our topics for today. We wanted to start with discussing predictions versus reality. We're going to go through a few different charts here. Shocker that we have charts in the webinar. Why are we doing predictions versus reality to start the year? Well, every January we read a lot of content, and in much of the reports that we're digesting, there are prognostications about what to expect, what will happen this year, and they're offered with so much confidence, and so often they're flat out wrong. What we're sharing with you on this particular slide is predictions about how the S&P 500, America's favorite index of stocks, would have performed over the preceding years. And so the folks at Dimensional put this visual together, and what you've got here is, each year, starting with 2021, you'll notice there's a little red dot at the bottom and a blue dot at the top. The space in between represents the range of predictions for how that particular index was expected to perform in each of those given years. Somewhere between 17 and 22 analysts were polled each year. The box in the middle, that's the median expectation for performance. The green dot is what actually happened. And so if you look at each of the 5 years, what you'll notice is that all of these analysts who are paid to know as much as they possibly can about how this index is going to perform, put their best guesses forward each year and missed almost every year, except in 2025. The range was wide enough, or the actual performance ended up falling within the range. But in most years, they had no idea what was going to happen. And we see this happen year after year after year. And yet we fall victim to, I don't know, the temptation of wanting to believe what a prediction would be, maybe because it helps us feel like there's less uncertainty in the world. But it's just not true. And this is one of the reasons why we don't predict, because you have no idea what's actually going to happen. If we move forward, we have another slide here focusing on predictions, but now we're moving beyond the US. So again, our friends at Dimensional put this image together, and we thought it was worth sharing with you. You'll see that none of these predictions ended up coming true. Each of the three that we've selected here are from the end of 2024. You'll see the dates kind of at the bottom there in the gray area. Again, offered with confidence, right? The U.S. equities are preferred over the Eurozone and emerging markets. We've got a slide for that here in just a couple minutes that we're going to show you that shows just how off that was. The same being true on, expectations for the dollar, and how stocks in China would perform. Now, we'll note, by the way, and if you've been an attendee of these webinars in the past or read any of our digest content, we stopped investing in Chinese companies back in 2022, strictly on the basis of a values-based decision, and the opaqueness of the reporting that comes from the People's Republic of China and how their companies are performing. But the emerging markets fund that we're using, even without Chinese stocks in it, has outperformed that core portfolio that does incorporate those stocks from China, by an average of about 3% per year since July of 2022. So we thought we'd incorporate that, and just note, it's interesting to see that people can't get their predictions right within the US. They can't get them right outside of the US either. And there are more things that we're being asked to make predictions about as it pertains to the year of 2026. Folks are asking us, are we in a bubble? We don't know. Is real estate ready to make a rebound? We don't know. Are stocks too expensive? Can't say. Can earnings remain robust within the tech sector or elsewhere? Hard to tell. Is 2026 the year that crypto comes of age? Stop it. That's not something that we're ever going to comment on or dignify with a response. There's no there there. There hasn't been, and we don't expect there to be. So on the topic of predictions, we wanted to have a slide here about market timing, because if you're trying to predict what will happen in the markets, you're probably then trying to figure out what you should do. Again, we emphasize, we do not make predictions, and we do not build an investment philosophy or an approach around trying to figure out what might happen in the future. So what are we showing you on this chart? The heading, market timing. It's hard to be right twice. What do we mean by that? If you go back to April of last year, everyone remembers, quote unquote, Liberation Day, the big board of reciprocal tariffs that President Trump shared with us. It was a Wednesday, by the way, April 2nd. I can't forget. Thursday and Friday of that week, markets fell by 5% on each day. So we ended the week down 10%. Not too many of our clients were calling us asking if they should get out of the market, but we did have that conversation with a few folks. And we reminded them of this concept. The bar on the far left, out here, shows you that if you remained invested continuously throughout all of 2025, including taking that hit at the beginning of April, your return for the year, as far as being invested in US stocks, was 17.1%. Now, if after the tariffs were announced and markets took a dive and you said, I can't take it, get me out, and you missed just a week of performance, you sacrificed 6 percentage points. Recall that just a week after Liberation Day, we saw a number of indices pop back up. Almost the S&P 500 almost popped up 10% in one day, just a week after, when pauses on many of the tariffs were announced. If you had waited a month to get back in, you sacrificed 13 percentage points worth of return. If you had waited a quarter, you were behind the performance for US stocks by nearly 23%, -6% just by missing 3 months. And if you had been out for 6 months, you were at -12%. It's almost a 30% swing between these two columns. And so here's the thing. If you're going to make predictions, you have to not only be right about when to get out, you also have to be right about when to get back in. It's really hard to get one prediction right. It's that much harder to get it right twice. And so we just want to remind our viewers and listeners of this fact and reiterate this is why we diversify. This is why we practice discipline and groundedness with respect to our clients' investments. And it pays. It pays to be disciplined.
And Yusuf, just back on
Yes,
that piece, I
sure.
was chuckling earlier because I was remembering our webinar roughly a year ago when we had the image of the tariffs, no tariffs, tariffs, no tariffs,
Right.
and because that's what it was like. And it's, one thing that always sticks with me on those examples, we often use dimensionals because they do a good job of putting together really good content, but it's not, that phenomenon is not new. It
Right.
happens when there are these scary moments in the market because people can't take it. They, maybe they don't have someone to help them have that resilience and confidence to stay in the market. And it happens every time where there are, short time periods where you can really drastically change the return that
Mm.
compared to if you just stayed invested the whole time. And so it's a really interesting thing for me to look at each time that there's a downturn.
Yeah, you got to stay in the boat as we are constantly reminding folks and reminding ourselves. I mean, we're human beings too, and we go through it. Um, 2025 was a fabulous year. Every single portion of the portfolio, whether it was stocks or bonds, was positive or had positive returns. We're only showing you the stocks here on this chart. The worst performing part of the portfolio was real estate. It was up 8%, tidy little return. Dwarfed, however, by again international small value. We've shared this over the past several webinars. For the year, clocked a 52% return, which is absolutely fabulous. And so always gratified to be able to report good information, especially when the chart looks like this. You'll notice, by the way, the S&P 500, which we were focusing on in some of the earlier charts, kind of here in the middle of the pack in terms of rank, 17 or 18% on the year. Again, nice returns, really nice returns. But we diversify because we want all of this. Now, on the topic of international versus US, if you noticed on the previous chart, the top five performing investments in our clients' portfolios were all non-US mutual funds. We thought this image, again, put together by the folks at Dimensional, was worth sharing. And so you're looking at a chart that's showing concentration in two indices. The darker blue is the S&P 500. And so what that's showing you is how much of the index is eaten up by the 20 largest companies. And you can see the share that those 20 largest companies, that the share they're taking up of the index has grown relatively consistently over the past 12 years or so. To now, those 20 companies represent 50, I'm rounding, 49%, 50%, call it half of the index, right? So an index of 500 companies, half the space eaten up by 20 companies, the other 480 fighting over the other half, right? Concentration is a risk because the bigger those companies are and the more size, the more space they take up, the more exposed you are. Case in point, look at how the market's performing today. Microsoft, multi-trillion dollar company, put out an earnings report yesterday, spooked investors. Last I checked, Microsoft is down 12% today, and that's pulling the whole index down, just one company. On the flip side, if you look at the lighter blue or teal down below there, for the MSCI All Country World ex-USA index, so that's an index of stocks around the world outside of the US. The 20 largest companies represent, again, we'll round, some 20% of that index, and that share has remained consistent over the past 12 years. And so we just thought we'd highlight that as yet another reason why we think it's very important to stay globally diversified and globally neutral to the extent possible. We don't want to overweight or underweight the presence of any one country in our clients' portfolios. And it's because of things like this. So with that, we'll continue.
And Yusuf, if before
Yes,
we, sorry, if you go back 2 slides, just had a good question, and
absolutely.
it comes up a lot when, especially recently, when we've been talking about international, just the question of how the dollar, the strength or the
Hmm.
the weakening of the dollar affects some of this international performance, and with the administration talking about their desires for the strength of the dollar and how that affects this chart here specifically.
Yeah, so we don't have an opinion about whether or not the dollar should be stronger or weaker. How it ranks relative to other currencies is just a naturally occurring phenomenon, and it moves, it fluctuates for various reasons. What we will say, however, is we don't hedge against currency rate risk. What does that mean? When the dollar weakens, it means that other currencies are stronger relative to the dollar. So when we are showing performance from companies outside the US and we're converting those returns back into dollars, the weaker the dollar, the more supercharged those returns. Because when we're converting back from whatever currency into dollars, if the dollar's weaker, we get more dollars when we convert. And so the returns are boosted by way of that dynamic. So yes, throughout the course of the past year, the dollar took a little bit of a hit, nothing that we haven't seen, in past decades, and nothing that we're concerned about. And however, yes, it's true that did further boost the returns that we're seeing um, and that our clients experienced.
Thank you.
Absolutely. So, we're preparing for this webinar and as we always do, reading a number of reports throughout the week and saw this particular headline. We did snip this from the Yahoo Finance morning brief. You may notice a typo in here. It's not ours. Um, Notice the focus, right? The major indices capped a second straight stretch of weekly losses as investors digested a wave of geopolitical headlines and navigated what remains an unsettling trade environment to start 2026. All the indices mentioned in that second paragraph are U.S. focused: S&P 500, the Dow Jones Industrial Average, the Nasdaq Composite. And so, if you were to just focus on this particular, headline or these couple paragraphs, you might think, well, shoot, that's bad news for my portfolio. Here's the thing. Your portfolio is made up of so much more than just US large stocks, US large company stocks. Um, we had a hard time. We tried to find a headline that focused on the all country world index, ex-US, which hit an all-time high this week. All anybody wanted to talk about was that the S&P 500 flirted with 7,000 for a bit. Also of note, emerging markets, companies in those countries have dominated all other segments of the market. And finally, we have to mention that small company stocks in the US have been outperforming large company stocks since April of 2025. So coming up on close to a year. But you don't necessarily see that in the news. And so that's why we report the information we report in these webinars. Um, Take that as pretext for this slide. It looks similar to the one that we showed you just a couple minutes ago, but this is just focusing on performance in January of 2026 through yesterday. So today's performance not included. But here it is. In January alone, the emerging markets fund in our clients' portfolios up more than 10%. There's international small value again approaching plus 10%, again, just in this month. And all your top performers continue to be international stocks. Listen, there's positive returns everywhere you look. Uh, Being up 2% in a month, nothing to be disappointed at. We're looking at you, S&P 500. Even the real estate fund approaching positive returns, close to 2%, all good. But international continues to dominate, and we're happy to report. Um, we look at these splits every quarter. As of the most recent report that we've been able to review, international developed countries and their publicly traded companies eat up about 25% of the global market capitalization. They represent 32% of the stocks in your portfolio. So we're tilted a little bit in favor. of international, and that's not because of a prediction that we're trying to make. That's not, just because we caught a wild hair or anything like that. It has everything to do with valuation and how attractively the stocks abroad are priced. Stocks in the US, particularly large company stocks, are currently priced very expensively. We prefer to buy stocks cheaply and then sell them after their price has grown. And so there are more of those types of opportunities available abroad. And so with that, we trust the math and position the portfolio accordingly.
And I think, Yusuf, I'll chime in and just share, we were thinking about doing a poll, a prediction poll in this about how many charts is Yusuf going to show us? One, two, or 500. And so these charts are really helpful and interesting. And I think, Yusuf, you're kind of where you were ending is that this is, 28 days. We're not changing anything based on this in a very short period of time. We're not making predictions that this is what all of 2026 looks like, just looking at what has actually happened. And we look at, like Yusuf said, we look at these quarterly, and it's really interesting, for at least for us nerds on this side, to see how things change all the time. And so some of you may have seen what we refer to as the Skittles chart in the past that shows all the all the funds in our portfolio, all the different sectors, international, international small, international large, US, and how they perform year to year. And there is no rhyme or reason. And so just coming back to that broad global diversification, it matters because you benefit from the best from everything in kind of grounded, reliable, reasonable amounts. And one question that we had come in or comment here is just on how it could be helpful to see the weighting in the portfolio of each of these positions. And that certainly is something that is, if we think about this, these are only the stock funds, and this, what we call the risky core, the stock portion of our portfolio, is the same for every one of our clients, for all of our own money and the way it's invested. But the end weights in each person's portfolio do differ a bit because based on risk tolerance, time horizon, phase of life, then on top of the risky core or added into the risky core are those global bond funds for stability, for dry powder if you're in accumulation, or for that stable reserve I was talking about earlier. And so your specific performance will be based on your actual allocation to stocks and bonds. And it is something that we certainly could add in the future to just show the weightings maybe on this of what each of these are in that risky core, that 100% stock piece of the portfolio. So thank you.
Yeah, it's great feedback, and we'll certainly include those weightings in future webinars. Would it be worthwhile, Lauren, if we go through and say them out loud for each one here and now, or?
Yeah, don't put me on the spot, but if you
No,
have
no, 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 no.
memorized.
I would never. No, no, no. I'll do it. No, of course. Emerging markets, 7%. International small value, 8%. International small, 8%. International large, 8%. International large value, 8%. US small value, 14%. US small, 13%. US large value, 14. S&P 500, 13. Real estate, 7. And real estate is a blend. It's got a bit of US and a bit of non-US in there. So that's how we end up getting to the 60-40 split, basically, between US and non-US for the portfolio. There was no shortage of energy committed to talking about a potential AI bubble bursting at the end of last year. We thought we'd spend some time checking in on that story in today's webinar. Continuing the conversation about predictions, it would seem that the rumors of the AI trade's demise were greatly exaggerated so far. Again, we're not predicting what might happen in the future, but so far, mostly good. We thought it important to note that the YeskeBuie portfolio of stocks that we just went over and the splits that we just identified outperformed both the S&P 500 in 2025 and also outperformed 5 of the 7 Magnificent 7 stocks. Not Google, not Nvidia. We'll talk about those particular companies in just a moment. When we are focusing on the Magnificent 7, and it's the stocks that you see listed here, Apple, Tesla, Microsoft, Meta, Nvidia, Amazon, and Google. All of them had positive returns in 2025. 5 of the 7 posted double-digit positive returns in 2025. And listen, the conversation around artificial intelligence is continuing and continuing to dominate, a lot of the spaces in which, we're consuming information. One of the reports we were reading by Bank of America noted that AI is a fundamental revolution that is about to change everything. And we cannot ignore valuations, right? So how expensively the stocks of these companies are priced, and all seven of these are priced quite expensively. And we can't ignore the timing, right, of just how this is all unfolding. Um, the analyst further noted that the tech sector is having to navigate the fickle winds of public opinion, especially around the data center build out that is sucking up so much cash. Furthermore, risking energy costs, heavy water usage, job security, and other concerns have all risen to the forefront. So, again, lots to talk about in this space. If we spend a bit of time just focusing on each of these companies and how they're doing, many of them, again, worth trillions of dollars. We'll start with Apple. We'll just go left to right. Apple has been a bit of a laggard in terms of artificial intelligence investment. Primary focus has still been on product development. So, their performance still hinges on how many people are buying iPhones. Um, Tesla, we say this tongue in cheek, but if Mr. Musk is actually going to realize the potential of his $1 trillion pay package, which is heavily incentivized, um, he's heavily incentivized to do so, and it is based on incentives and escalators. Um, he's got some work to do. Tesla last quarter reported a profit decline exceeding 60%. Yikes. Microsoft, again, earnings report yesterday. Investors didn't like it. We already talked about it, down double digits as of today. We'll see how that continues to unfold. And a lot of Microsoft's outstanding obligations are tied to OpenAI, which is a company that's not yet publicly traded. We'll touch on that in a moment. Meta, doing well. News has been good. Up big today, by the way, on the strength of their most recent earnings report, and is being described as one of the world's most dominant media companies. And they are still making those glasses that some people are wearing, not us. NVIDIA, flat to start the year after being up almost 40% last year. It's still seen as the backbone of the AI build out, and its performance is directly tied to the rest of these companies who are all buying the chips that NVIDIA makes. You may have seen in the news this week that Amazon just cut 16,000 jobs in addition to, I think it was 14,000 jobs that were cut last October, so a total of 30. Um, they're cutting costs, redirecting resources towards more AI development, um, and seeing where that takes them. And then here's the star of the show. Would you believe me if I told you that Google is up 105% since May of last year? That's nuts. It's just incredible. They've continued that performance this year. It's interesting to observe. Again, not changing how we're investing, but just something that we're paying attention to. And not shown on this chart, but relevant to the discussion, SpaceX, that's a Elon Musk company, as you well know. OpenAI and Anthropic, both big in the AI game. Um, Valuations for each of the three companies, SpaceX 800 billion, OpenAI 500 billion, Anthropic 350 billion. Um, all three could go public this year. And so it'll be interesting to see what that might do in terms of how the market moves. So again, we're watching. The bubble has not burst as of yet. If we are in a bubble, and we'll continue to pay attention and report on this throughout the year.
That was a fun slide, Yusuf. I was just thinking about the stories that you had for each of those stocks like last week compared to all the new updates that you shared today based on yesterday's announcements.
Yeah, for those who don't know, the webinar presentation, our development of this goes right until we go live because the news is always changing. And it's fun for us to make sure we have the most recent developments available to report on when we get together with you. Um, we're going to share a few pieces of information about economic indicators that we're paying attention to all the time. First, we'll take a snip from yesterday's statement from the Fed after they concluded their first meeting of the year. And I quote, the available indicators suggest that economic activity has been expanding at a solid pace. We have numbers for that. Job gains have remained low, and the unemployment rate has shown some signs of stabilization. Inflation remains somewhat elevated. And so, with that, let's have a look at a couple of things. Number one, gross domestic pot, gross domestic product, GDP, the measure of economic output. The most recent quarter that's been reported is the third quarter of 2025. We're standing by for the Q4 numbers, but 4.4% annualized growth in Q3 of 2025, strongest quarter in a couple of years. That's good news, objectively. Um, when we look at inflation, we'll just note that inflation has been hovering around 3% for the better part of the last 2.5 years. Clocking in at 2.7%, no matter how you measure it. CPI, which is headline inflation, consumer price index, core CPI, which strips out food and energy costs, which are a little bit more volatile. PCE, the measure that the Fed prefers, personal consumption and expenditures, all right around 2.7%. So that's the number. It also is aligned with the cost of living adjustment for Social Security benefits. For those of you who are collecting, you'll notice your benefits have grown by 2.7%. And Lauren mentioned our safe spending analysis earlier in the presentation. That's the inflation rate we're using. So if you got your inflation raise this year, your spending target increased by 2.7% to keep up with inflation. Unemployment holding steady around 4%, clocking in at 4.4% as of the most recent reading. We'll note that the 10-year bond didn't move as a response or in response to yesterday's Fed announcement to keep interest rates the same. That's good news. If it's holding steady, that's a good thing. The 10-year bond is an indicator that a lot of folks look at to try to gain an assessment of where things are in the economy. Moving along, mortgage rates still hovering around 6% with no expectation that they'll come down anytime soon. It's here that we'll note, by the way, that the historical average is right around 5.5%. So, the years in which we were seeing 2 and 3% rates, those were the anomaly. And the general consensus is that it would take another really bad thing to happen in the economy to bring rates that low. So we're watching and just noting that 6% isn't much higher than the historical average there. And finally, we wanted to make a point about gold because how can you not talk about gold when gold is trading at $5,300 per ounce? We'll just make some points here. When people talk about the rise of the price of gold per ounce, what we want to make sure our clients and viewers on this webinar understand is that this is a fear-based rally. People respond to things that they're afraid of, sometimes knee-jerk, and say, oh, I'm worried about this. I should buy gold. Tensions with Iran, buy gold. Dollar losing value, buy gold. Is the AI bubble popping? Buy gold. Is the dollar, not going to be the reserve currency of the world? I should buy. That's not an investment. That's not how we invest. That's speculation. It's important to note that nothing has changed about the intrinsic value of a gold bar. Nothing has changed in a significant way about the demand for gold, and certainly not in a way that justifies the ridiculous price increases that we've seen over the past year or so. So this is something we observe and we move on.
And has definitely been in the headlines.
Yeah. We get questions a lot, should I buy gold? And we talk clients through and say no, first and foremost, and then here's why. And further, if you have a bunch of gold bars sitting around at the house, just put yourself at risk.
Is it gold or silver, that silver bars that they're selling at Costco now?
Yes.
I think I saw silver last time I was there.
Yes, and I think they were going to do platinum too. Don't buy any of it.
And Yusuf, a great question just came in. By the way, questions, feel free, throw them in at any point. But just back to the gold piece related to that discussion, is there any commodity exposure in the portfolios?
Not directly. So we do not engage in commodities trading, alternatives. We don't make any currency plays, certainly no crypto. To the extent that companies use something that you would put in the bucket of commodities, wheat, for example, right? A company that takes wheat and makes bread. Yes, you'll find those companies and their performance is going to be reflected in how your portfolio performs. because that's where economic value is created, right? You take something, you make something else out of it, and then you deliver that to consumers. That's again, how economic value is generated. Those are the companies where you want to invest, is they're taking something and creating value. That's where you want to be participating, not just speculating about what the price of, a bushel of wheat might be or a barrel of oil in a week or a month or a year. Making bets on what that number will be, again, to us isn't investing. That's just speculation. So with that, we mentioned the Fed just a moment ago, making a couple more comments about interest rate expectations, given what Chairman Powell noted yesterday in his comments. Expectations should not be for more than 1 to 3 cuts this year. And so, one more time from the good folks at Dimensional, we have a range of expectations listed here. You can see at the top left, that blue dot is showing where interest rates are right now. And the expectation through the year is, again, maybe we see 1 or 2 cuts. But we'll have to see how the year plays out. Any
So we've
questions
got
coming in?
we've got
Yeah,
one
yeah, go ahead.
question coming in. Feel free Q&A or in the chat if you have additional questions because we've got lots of space for them. But a
Mhm.
question back to the gold topic. If you have gold coins, is now the time to cash them in?
Not a bad idea. It's at an all-time high. So, something to consider. And if that's something you want to talk through more in depth within the context of your financial plan, give us a call, please. We'd love to walk that idea around the block with you and determine what the next best step might be.
Great. And one thing, Yusuf, that was coming to me in just thinking, everything that we share in these webinars is looking at pretty short time periods, right? We're looking at
Hmm.
the past year and the past month, and we're thinking about what could be coming, not making predictions, but just looking at what are the things that are on our radar and how might those play into the financial plans or rebalancing that we might see coming this year. One of the things that's happening with all this trading right now and topping up that stable reserve for clients is realized gains. And
Yep.
sometimes that feels painful, but at the end of the day, it's because the portfolio has done so well. And something that was just coming to me as I was listening is thinking about, okay, so what do we do with this information? Do I need to change my financial plan because the Mag 7 have done well, but now international is doing so much better in this period? Does that affect my ability to retire in 20 years or my safe spending target? And so, I think maybe last webinar or 2 webinars ago, I was sharing about how volatility is built into your financial plan
Yes.
because we know it exists. We don't think we can predict the magnitude, timing, or what it's going to look like, which countries or companies are going to do better than others at different times, but we know there will be volatility. It's part of the game. It's why you get paid for staying invested in the long run, because you're willing to take on those risks and weather the volatility. And so for those of you who are maybe in that accumulation phase, you might be familiar with the Monte Carlo, or what we call the tornado chart. And so in your financial plan, that tornado chart looks at random rate of inflation, random rate of return to your investments for each year for 100 years. And then it runs 10,000 scenarios there. And that's what gives you that tornado chart. And so that's how we feel confident in the path you're on and that we're course correcting and talking about it every year. Whatever happens this year is one of those 10,000 possibilities. And the same thing with the safe spending system. There were many Monte Carlo simulations done in the empirical research behind that system about all these possible outcomes and how those guardrail rules apply and maintain the sustainability of your spending target. And so it feels almost silly to say, like, don't do anything different. We're paying attention all the time, but it's not about trying to predict what's happening and reacting in the second. It's about knowing you have that resilience built in and that, things have been stress tested. And so as the market is reacting to what happens, which by the way is what it should be doing,
Yes.
you don't have to think constantly, what do I need to change today? What do I need to do differently today? You know that you are solid on your path. And those questions about gold, about fears about AI, about fears about US versus international, any of those, we're always, always available to talk about those. We love it. There is no question that you can't ask us that we don't want to talk about related to you, your financial plan, the markets, whatever is going on in the world, what's on your mind. But just wanted to bring it back to that, the financial plan is stress tested. And so we share a lot of details in the moment, things that are coming up, but not because you need to change something this second based on what the headlines say today or tomorrow.
Absolutely. Well said, Lauren.
And with that, we don't have any additional questions that have come in yet. So yeah, let's move on.
Yeah. We'll look at the road ahead. Things we're paying attention to. The Fed takes February off. They'll get together again in March, and we'll look to see what announcements come out of that meeting. We're also paying attention to the Supreme Court. You may have seen in the headlines that a decision is pending on whether or not President Trump's use of some of the obscure rules available to him in putting all these tariffs out was within the rules or not. And if not, tariffs might need to be rolled back. So it'll be interesting to see how things play out there. Um, in addition, we'll be getting together again sometime in April, date to be determined. Stand by for that. And we have already identified the dates for our in-person events, and we'd love to see you if you can make it on either coast. We'll
Or
be doing
both.
or both, by all means. We'll be doing our San Francisco event on July 16th, and we'll be doing our event here in Virginia on August 6th. And would love to see you if we can get an opportunity to do so.
All right, I'll give it like 10 seconds for any final questions that come in.
And if not, as always, pleasure hanging out with you all for the past 45 minutes. Not so bad today.
Thank you all.
Thanks so much.